Ladies and gentlemen, welcome to the show. It is Ask the Experts here on Talk Radio 1190, where we interview local prominent professionals here in the Dallas-Fort Worth Metroplex on what, well, their area of expertise. Of course, I'm the host of the show, Matt Cather. Joining me on today's show is Josh Strittmatter of Strittmatter Wealth Management Group. Great to have him back. Josh Strittmatter is the founder and president of Strittmatter Wealth Management Group, a registered investment advisor located in downtown Fort Worth, Texas. Josh is a certified financial planner and fiduciary that's been practicing since 2003 here in the DFW. His firm specializes in retirement planning, estate planning, and investment management. And all information discussed on today's program is meant to be for educational purposes only. And for more information, including key disclosures, please visit their website at strittmatterwealth.com. I'm going to spell that out for you, folks. It's STRITTMATTER wealth.com. Good morning, Josh. How you doing today, sir?
Good morning, Matt. I'm doing great. How about yourself?
Man, I am doing fantastic. Really excited for today's show. It's been a great week. I expect this show to be awesome as well. But, Josh, before we get started, I know you love to educate, and you're always teaching classes and writing articles. So why don't you tell our listeners what you have for them today?
Matt, I am always excited to talk about what we do from an education standpoint. And we have been teaching classes for several colleges in the area for over a decade now. So if you're interested in learning more about retirement planning or Social Security or estate planning, just go to our website to sign up. Something else I'm excited about is a report titled The Top 10 Retirement Mistakes to Avoid This Year. Now, this is a great resource for people who are looking to retire in the near future and just looking for some great tips and some things that they should avoid. And you can tell them how to get that.
That's right, folks. All you need to do today to request this resource is just go to strittmatterwealth.com. You click on Resources and Free Report. That's strittmatterwealth.com. Click on Resources and Free Report. You got a couple different ways you could do it as well. You can also email them at info@strittmatterwealth.com. That's info@strittmatterwealth.com. Give them a call. They'd love to hear from you. It's 817-210-3444. It's 817-210-3444. And for all my texters out there, just text 1190 AM to phone number 44222. Just text 1190 AM to phone number 44222. All right, Josh, I know this week you geared your show around a theme, so why don't you tell our listeners more about the theme for this week?
Matt, this week's theme is Roth IRAs. So these are some great questions that we've received around Roth IRAs.
Fantastic. Perfect. Looking forward to it. On today's Ask the Experts, we got Josh Strittmatter of Strittmatter Wealth Management Group. Topic of conversation is Roth IRAs. Very cool. Let's get into the first question. We'll kick things off on today's show, Josh. We'll start in Euless with Leslie. Leslie was wondering, well, how is a Roth IRA different from a traditional IRA?
Great question, Leslie. So there's a few key differences. The first is that when you contribute to a Roth IRA, you are contributing after-tax dollars, meaning you've already paid income tax dollars on those, or income tax on those dollars. So whereas with a traditional IRA, you are either contributing pre-tax dollars or after-tax dollars, depending on a few different things that are required to be able to do either. That's number one. Number two is that with a Roth IRA, your earnings and your growth grow tax-free, so you never pay tax on the growth of it, as long as you met a few requirements, which are two requirements, really. It's the 5-year aging period, so you have to have started the account and contributed to it. Your first contribution must be 5 years old before you start taking money out, and then you also have to be age 59 and a half or disabled or deceased before you take money out of it. Where the traditional IRA, when you contribute to a traditional IRA, the money grows tax-deferred, so you'll pay tax on the earnings and the growth when you start to pull those funds out. But it will be delayed until you need that money. So taxation of the growth of it is a second key difference between the two. And then third is looking at when you can withdraw the money. With both of them, those I just mentioned, you have the age 59 and a half rule. Roth IRA, again, subject to that 59 and a half rule with one key difference. You can actually pull out contributions before age 59 and a half. You just can't pull out earnings before that, before age 59 and a half. And so the great thing about a Roth IRA is that you pull out your contribution first and then earnings in terms of how it's taxed. And so what that means is that Roth IRAs you can typically pull money out in the same year that you contribute to them, as long as you don't pull out more than your contribution. So those are some key differences that I think about. One of the key differences, actually, Leslie, that I'll mention too, is that the Roth IRA is not subject to required minimum distributions. Those start when you turn age 72. And so those are required distributions by the IRS. You have to start taking money out and start paying tax on it. So with a traditional IRA, you do have required minimum distributions that start at age 72. Roth IRAs, you don't. And that's one of the key benefits of a Roth IRA as well. So those are some great differences, Leslie, between a Roth IRA and a traditional IRA. Hopefully that helps you.
I'm sure it did, Josh. And I know the next question is going to be from Ernesto in Alito. He was wondering, should I consider converting into a Roth IRA?
Yeah, good question, Ernesto. So typically we talk about a Roth conversion. And what that is basically where you convert a traditional IRA or a 401k to a Roth IRA. And in doing so, you are taking that money that's in that traditional IRA and you're paying tax on it in the year of conversion. And then that money goes into the Roth IRA, and then from that point forward, it grows tax-free for you. So a few things I think about. First of all, you need to talk to your tax advisor because there are some tax implications. Again, you're going to pay tax on that amount that you convert. So be sure and talk to your tax advisor first, Ernesto, before doing that. And then secondly, what I think about is when you do that conversion, you're going to owe that tax. And so we always advise clients that if they have access to other funds, so from from their savings account or from a non-qualified account, that they actually pay the tax from those accounts rather than paying the tax out of the IRA. What that allows you to do is put more money into the Roth IRA because those dollars that would have gone to pay taxes are actually going into the Roth IRA. So you're using other funds to pay the taxes, if that makes sense. Also, there's a 5-year aging period, too, with the Roth conversion. So those funds need to be held in the account for 5 years. So also thinking about your time, we also talk about that 5-year period in terms of the aging requirement, but also your break-even period. So when will you need this money in the future, and will you have time to make the money back that you paid in taxes? Also, just keep in mind, too, that if you're converting before the age of 59 and a half and you're paying tax from the traditional IRA, there may be a 10% penalty, so you need to be sure and do the math before you do that. Lastly, I would say one of the key benefits, too, is, as I've already mentioned, is that there's no requirement of distributions from the Roth IRAs, and there is from the traditional IRAs. So that's one of the key advantages of doing a Roth conversion is to let that money stay in your account until you die, and then if you're married, you can leave it to your spouse, and they can leave it in their account till they die. And then when the non-spouse beneficiary inherits it, that's where it's subject to some different rules, what they call a 10-year rule now. So hopefully that helps.
Really like this next question. It's coming from Joanne in Patego. She asks, what are the potential tax implications of converting, Josh?
So Joanne, yeah, I was just talking about that. So when you convert from the traditional IRA to the Roth, again, you're going to owe tax on the money that you convert, assuming that you haven't been taxed on it already, by the way. So if you made non-deductible contributions to a traditional IRA, that principal has already been taxed. And so when you convert that principal over to the Roth, it would not be taxed again. So it's only the pre-tax contributions that you made to a traditional IRA that are taxed. And then, again, as we talked about, is that when you pay that tax, you can either pay it from the traditional IRA, which means less money goes into the Roth IRA, or you can pay it from outside funds, from cash or from your non-qualified assets. In doing so, again, that maximizes the amount of money that you're putting into the Roth IRA. And in doing so, it also helps you to, again, if you're below the age of 59 and a half, avoid paying the 10% penalty on the amount that's going to pay the tax, because they actually penalize you for paying taxes out of the IRA when you're below the age of 59 and a half. So you obviously want to avoid that. Beyond that, I would say that, when we talk about taxing or paying tax on a Roth conversion, we also advise clients to convert up to their tax bracket. And so I'm talking about the income tax brackets, is looking at what income tax bracket that you're in and the ceiling of that income tax bracket, and then only converting up to that income tax bracket ceiling so as to not go into the next tax bracket. And so that's something that we also discuss with people. So, Joanne, those are some things to think about when you're thinking about a Roth conversion in terms of the taxes.
Remember, folks, this is Ask the Experts here on Talk Radio 1190. We're talking with Josh Stripmatter of Stripmatter Wealth Management Group today in regards to Roth IRAs. If you want to reach out to the fine folks at Stripmatter Wealth, well, you can find them online first at stripmatterwealth.com. You could also give them a call, 817-210-3444. It's 817-210-3444 is the number you can reach them at. Continuing along, we got a couple more questions before we take a quick break. Next question's coming from Bobby in Fort Worth, where, of course, the offices of Stripmatter Wealth is located at. He asks, what type of accounts can you convert, Josh?
Bobby, great question. So here's the list for you. So traditional IRAs, which also include your rollover IRAs, your SEP IRAs, your SAR-SEP IRAs, your simple IRAs are all eligible to be converted to the Roth IRA. If you have a simple IRA, there's a specific rule, though, that contributions can't be converted to a Roth IRA during the first 2 years of starting your contribution. So remember that rule. And then rollover IRAs containing assets from an employer-sponsored plan account are also eligible to be converted. In addition, balances from employer-sponsored savings plans, things like 401ks, 403bs, 457 plans that are eligible for distribution and rollover may generally be converted as well. So the answer is anything that's a qualified plan, basically. In other words, money that you save pre-tax and gross tax deferred is typically eligible to convert to a Roth IRA. But again, just consult your tax advisor before doing that conversion just to make sure you're checking all the right boxes.
Last but not least, before we take a break, Josh, this one's coming out of Irving from Judy. She asks, do Roth IRAs have required minimum distributions?
Yeah, Judy. So as I mentioned earlier, the great thing about Roth IRAs is they don't have any required minimum distributions. And so that just means that you don't have to start taking the money out at age 72 like you do with traditional IRAs. And so when we talk about required minimum distributions, that's an amount that's distributed from your IRA account starting at age 72, and it goes all the way through the end of your life. It starts out at a pretty low amount, a little bit less than 4%, and then it goes up every year based off of life expectancy. And there's IRS tables that you can look at to do that calculation. But with the Roth IRA, you don't do that, so you can keep that money in your account until you're dead. And again, you can pass it to your spouse, and then they can leave it in their account, and it grows tax-free that entire time frame. It's at the non-spouse beneficiary, or when the non-spouse beneficiary inherits, is there's now subject to the 10-year rule where they have to take it out within 10 years. And so that money continues to grow tax-free over that 10-year time frame. So you can have a lot of years of tax-free growth, and that's why a lot of people look at the Roth conversions. One other minor rule is that if you have a Roth 401k, one key difference between a Roth 401k and a Roth IRA is that with a Roth 401k, you are subject to required minimum distributions. So what a lot of people do, Judy, is they roll that over to their Roth IRAs to avoid that once they've retired from their workplace. So that's just something to keep in mind as well.
All right, folks, we got to take a quick break here on Ask the Experts. Remember, we're talking with Josh Stripmatter today in regards to, well, Roth IRAs. We got a lot of information to still cover on the other side of things, so stay tuned. This is Ask the Experts here on Talk Radio 1190.
So-called Social Security.
Welcome back to the show, folks. This is Ask the Experts here on Talk Radio 1190. We interview local prominent professionals here in the Dallas-Fort Worth area. Today, we're talking with Josh Stripmatter. He's the founder and president of Stripmatter Wealth Management Group. Of course, his office is located in downtown Fort Worth, Texas. If you'd like to reach out to him, well, you can find him online at stripmatterwealth.com. That's stripmatterwealth.com. Phone number, 817-210-3444. 817-210-3444. We always have Josh on. It's always a pleasure, more importantly. Today's topic of conversation, well, it's Roth IRAs. We got a lot of information to still cover, so let's jump right back into it, Josh. We got a question coming out of Alito from Marcia. Marcia was wondering, what are some drawbacks of Roth IRAs, if any?
So, Marcia, here's a few things that I think about. First of all, you have the 5-year waiting period to withdraw the earnings. So, again, once you make a contribution, it starts a clock. It's based off of your first contribution. So every contribution doesn't start a new 5-year clock, by the way. It's just the first contribution, or when you do a rollover, or a conversion. That's one thing to think about. But as we already talked about, the taxation is a little bit different for Roth IRAs. So you can actually access the Roth IRAs, the contributions that you made in the same year that you made them. You just have to be careful not to pull out more than the contributions. In other words, don't touch the earnings. So that's something to think about. And again, the penalty for pulling out earnings is the 10% penalty and taxation on the amount. So it's not on the principal, just on the earnings that we're talking about. And then also, there's no tax deduction. So with a traditional IRA, assuming you're eligible, you can deduct the IRA contribution that you make, which can help reduce your taxes. And so typically people who are eligible to do that is if they don't have a workplace retirement plan. So if you don't have a 401k, you can make an IRA contribution and deduct it, or you are below a certain income limit and you have a workplace retirement plan. Now, those limits are quite low, and you can look those limits up, and they index every year. But for a lot of people, that makes it pretty hard to make a deductible contribution. Again, that's something to think about. And then, Roth IRA contributions are also limited in terms of who can make those. So if you make too much money, you can't contribute to a Roth IRA. And so for a lot of our clients, that's their problem, is they make too much money, so they can't contribute to the Roth IRA. And then they also have a workplace retirement plan, which means they can't deduct their traditional IRA because they make too much money. So then what we talk about with them is what's called the backdoor Roth IRA, which is basically contributing to a traditional IRA, a non-deductible contribution, and then converting it to the Roth IRA in the same year. And so that's an effective strategy to make contributions to Roth IRAs when you make too much money.
Moving right along here on Ask the Experts, Vicky from Arlington. She asked, why would anyone ever choose a traditional IRA over a Roth, Josh?
So, Vicky, there again is if you're trying to reduce your income tax, a deductible traditional IRA is a great tool to do so. A Roth IRA contribution, there is no deduction, so you do not reduce your current income tax when you make a Roth contribution, or for that matter, when you do a Roth conversion. Yeah, that's the key difference.
All right, we got a scenario that our friend Mac is facing in Fort Worth, Josh. So my spouse is taking a few years out of the workforce in order to raise our young children. Can I contribute to an IRA on my spouse's behalf? Very good question.
Great question, Matt. So, yeah, you can make a contribution on behalf of your spouse. You just have to file jointly when you file your taxes, and you have to have enough income to make the contribution. In other words, so one thing we haven't talked about, Matt, are the limits for IRAs and how much you can contribute. And with a Roth IRA and a traditional IRA, the limit is $6,000 if you're under 50, and then it's $7,000 above 50. And so you have to have earned that amount of money from a job to be able to contribute that amount of money. And so in this case, if a married couple wanted to contribute to their IRAs, one's not working, they had to have made, and they want to contribute the maximum, they have to have made $14,000 from a job, or one of the spouses had to make $14,000 from the job in order to contribute on behalf of themselves and then their spouse. Also, you can phase out of deductibility just like you can for yourself, and that's based upon the IRS limits, and you can look those up. Right now, it's $214,000. If you make more than $214,000, you're phasing out of the ability to deduct it, and again, that indexes every year. So the answer is yes, and again, just deductibility is the key question as to whether or not you can deduct it or not.
817-210-3444. It's 817-210-3444. That's the number you could reach them at. Of course, their website is stripmatterwealth.com. It's stripmatterwealth.com. And folks, if you still want to get the top 10 retirement mistakes to avoid this year, you go to their website, stripmatterwealth.com, and you can just click on resources and free report, and that's exactly how you can pull it up. And if you want to email them at info@stripmatterwealth.com, you got a couple options to get that report. Now, Josh, we got two more questions before we wrap things up here on Ask the Experts. This one's from Isaac in Forest Hill. Isaac asks, can I name a trust as a beneficiary of my IRA or Roth IRA?
Great question, Isaac. Yes, you can name a trust as the beneficiary of your IRA or your Roth IRA, but keep in mind that the trust needs to have specific verbiage in it that allows for that. So you want to make sure you talk to your attorney, your estate planning attorney, who's drafted that trust for you to make sure that that verbiage is in place before you do that. Also, you never want to just change the ownership from an IRA to a trust. That is a taxable event, which means that all of those funds would become taxable if you change the ownership from an IRA to a trust. So you would keep it in an IRA, and then you would make the trust the beneficiaries of that IRA if you wanted to go down that route.
All right, Josh. Well, last but not least, Sue from Weatherford was wondering, well, how can Strip Matter Wealth help me with Roth IRAs?
Yeah, Sue. So, a lot of what we do for our clients is helping them with their investments and helping them to make and decide on which contributions to make to which IRAs. And so, we set up Roth IRAs for clients every day. And in doing so, we make sure that you are eligible, number one, to make a contribution. But number two, if you're not, we give you other options like making the traditional IRA, doing the backdoor Roth conversion, again, which allows you, if people make too much money, to contribute to a Roth. But we also talk about Roth conversions with clients. And there's some key calculations that we do on the Roth conversion to make sure it's in your best interest to do the Roth conversion, and some of the things that we've already talked about today. So our analysis looks at all of the different ramifications of making IRA contributions and Roth conversions, and basically gives you the information that you need to make a decision. And so then we help you to facilitate it. We open up the accounts. We invest the money based on your goals and objectives and just make sure that everything is done correctly for you. And that's how we can help you, Sue.
Fantastic. Another great show in the books with Josh Strip Matter here on Ask the Experts. But before we close things out, Josh, I know that's all the time we have for questions, unfortunately, but do you have any closing remarks for our listeners?
Absolutely, Matt. I want to thank our listeners for their great questions and, as always, for tuning in. I also want to invite them to sign up for our financial education classes, or they're welcome to just schedule a complimentary consultation. And what that looks like is a 1 to 2 hour meeting in our office where we talk about your goals and objectives and help you to formulate a plan to achieve them. Also want to encourage our listeners to download our free report titled The Top 10 Retirement Mistakes to Avoid This Year. Matt, as I've mentioned, this is a fantastic report for people who are nearing retirement and just looking for some great tips and some things that they should really avoid as they prepare for retirement. And you can share with them how to get it.
Yeah, again, folks, to request this resource, just go to stripmatterwealth.com. I'll spell it out one more time, STRITTMATTER, wealth.com. You click on resources and free report. You can also email them at info@stripmatterwealth.com. That's info@stripmatterwealth.com. Phone number to reach out to them? Well, it's 817-210-3444. It's 817-210-3444. Or just text 1190 a.m. to phone number 44222. Just text 1190 a.m. to phone number 44222. And real quick before we sign off, Josh, you just brought up those classes as well. Well, I tell you what, fall is right around the corner, so people need to get out there and get registered for those classes. What do you think?
Yeah, and they're all on our website, Matt. So if you go to stripmatterwealth.com, you can sign up for all of our classes. And we are adding new classes all the time, so be sure and check frequently to see what's being added. But yeah, they are welcome to sign up for those classes now.
Absolutely perfect. I wanted to point that out, hey, because I know the fall semester's starting for a lot of folks. So reach out there and get things started and get in one of those classes so you continue to learn a lot. Another great show in the book, Josh. I look forward to doing it again here soon, okay?
Thanks, Matt.
Absolutely. You've been listening to Josh Strip Matter, owner of Strip Matter Wealth Manager Group, located in downtown Fort Worth, Texas. Josh is a certified financial planner and fiduciary, and his firm specializes in retirement planning, estate planning, and investment management. If you'd like to ask him questions directly, you can email him at info@stripmatterwealth.com or give him a call, 817-210-3444. That's 817-210-3444. Well, of course, it's always a pleasure having Josh on Ask the Experts. We really enjoy the content he brings to the show. Until next week, we'll do it again, all over again. This is Ask the Experts here on Talk Radio 1190. Have a good day, folks.
And your so-called Social Security.